Justin is run by a bunch of investment bankers, and Morningstar's modus operandi.
For Morningstar.com, I'm Jeremy Glazer. Google beat analyst expectations again in the first quarter. I'm here with Morningstar equity analyst Larry Witt to talk a little bit about what drove this outperformance. Larry, thanks for joining me.
Absolutely, Jeremy. Thanks for having me.
So what was the most surprising aspect of this earnings release for you?
You know, I think one thing that's important to point out is that Google's revenue not only continues to grow, but it's accelerated over the last 3 quarters. So revenue growth is getting stronger. We think there's a few things really benefiting Google right now. First of all, you've got the secular shift of advertising online. Google continuing to take market share within that category, but also as the advertising market is improving overall, thanks to a stronger economy, you've seen their revenue growth accelerate over the last few quarters. And I think that's a pretty good indication that other media businesses will fare better this quarter than they have over the last couple of years.
Is there any big divide between revenue from the United States and advertising revenue abroad?
They're actually both pretty strong right now. International growth had been stronger for quite a while, even though the whole world was going through this financial crisis and this economic slowdown. They were still far behind in terms of actually penetrating these international markets. There was a much smaller percentage of revenue going to search, so there's still a secular growth that was masking some of the economic weakness. So that had continued to grow pretty well throughout, whereas the U.S. market was pretty weak for a while, but that's come back pretty strong, and both segments are growing quite nicely now.
Are they growing profitably, or are they just growing?
No, absolutely, they're growing profitably. Actually, their operating margins actually have expanded throughout the economic downturn, and still now it's expanding. They've been much more disciplined than we anticipated in cutting costs, shutting down some of their pet projects, if you will, that really were never going to turn into real businesses. And they've done a pretty good job of that. In addition, they actually they cut their capital expenditures quite a bit, since the second half of 2008. So as that bleeds through the income statement and depreciation and amortization, their operating margins improved quite nicely.
Google really is a giant advertising company. Sometimes we like to think of it as the next Microsoft, or they're competing with Apple, or they're crusading for human rights in China. It's really an advertising business, but they do have a few kind of these side projects, and the mobile phone business is one that we hear a lot about. They're now selling their own phone and also have the Android operating system. Is that something that they're gaining traction in, you see as a bigger part of the business, or is it still just going to be a hobby?
I think it is important for Google. I think when you look at the number of Android phones that are on the market, it's clearly gaining market share. Problem is they don't really make money off of most of those phones. They do sell their own phone called the Nexus One, but really that's just a souped-up Android phone. And I think overall what their main goal is to maybe negate the power that an Apple has. So even if they're not making money on every phone that's shipped, the fact that these phones are being run on a Google operating system, they know that people are going to be using Google Apps, Google Search, and they're going to earn revenue that way. So for example, if Apple was the only game in town, they could say, look, Google, if you want to be on our platform, you're going to have to pay us an exorbitant amount of revenue share. So they're really trying to negate Apple's power.
Finally, what's your view of Google for the rest of the year, the upcoming years, and also on the valuation of the stock right now?
Yeah, we currently think it's fairly valued. Our fair value estimate is $550. It's currently trading around $560, $570, depending on what it's doing after hours. But overall, we think it's a good company. But as you mentioned, it's an advertising company. 95% of their revenue comes from advertising. So I wouldn't really compare it to other tech companies like an Apple or a Microsoft, but just realize that this company is going to grow as they're able to grow their advertising revenue. And that's pretty much what it is, and it's going to be for the foreseeable future.
Larry, thanks for talking with me today.
Thank you.
For Morningstar.com, I'm Jeremy Glazer.
At Morningstar, we feel it is important to schedule regular checkups of your investments. This is the reason we're pleased to announce Portfolio Monitor, a new and easier way to keep track of your investments. With a few clicks of the mouse, receive a monthly report that provides a comprehensive and customized summary of your portfolio, sent automatically to your inbox. Portfolio Monitor provides a concise digest of all the best features of premium membership. Become a premium member with our 14-day free trial to start receiving Portfolio Monitor today.